Hello and welcome to Stocks Down Under. Today we're talking to Scott Jewler, the CEO of Revasum. This week we saw the announcement by the company about that new financing arrangement. Can you talk a little bit about that and what it means for Revasum?
Yeah, so I think just kind of starting with the background, we announced in September of last year that we had violated one of the minimum cash covenants of the loan that we had with SQN. And I had only been on the job for a month, and our CFO, Bruce Ray, had only been on the job for a week. And I think, to SQN's credit, they gave the new management team time to come in and to assess the business and to understand, what the opportunity was in terms of both controlling costs and also growing the business long term. And so we spent quite a bit of time with the lenders. We had a very regular, they have information rights, so we shared what we were doing in quite a bit of detail. They visited us, saw the tools, got to understand our business plans. And so earlier this year, it became obvious that we did need to put some more cash on the balance sheet, and that it was beneficial to our shareholders and also to the lender that we do something along those lines. And so, the agreement that we announced earlier this week is kind of the result of all that. It provides for $2 million of cash injection from First Hand, who's our largest shareholder, and it gives us some relief. It's forbearance from SQN on the prior defaults. And also, as a result of that, the interest rate on the debt reduces back to the original rate, so it saves us cash. And then also, SQN agreed to push out the amortization, which would have begun in March 1st of this year, to January 1 of 2024. So all those things together, really strengthen the company's cash position and really provide certainly sufficient working capital for us to execute the business that we see in front of us through this year for sure.
Yeah, okay, because I was going to ask about the capital requirements for the current year, so 2023, maybe early next year. So this solves a big part of that problem then. Is there anything that that you could use extra in terms of, say, product development or to expedite growth?
Well, what we've been doing over the last 5 or 6 months is heavily customer focused. And so, what we learned is that, we don't have a lot of competitors. We have some competitors, certainly, but there aren't a lot of people building the type of tools that we build. And so, our customers want us to remain in the market. They want us to be a strong competitor, and to provide quality tools. They like a lot of features and attributes of the equipment that we sell today, but the market's expanding rapidly. And so, for example, in the CMP space, the tools perform very well in terms of achieving the surface finish that the customers require. But like other tools in the market, they consume consumables, slurry materials, pads, and things. And so, customers and they consume water, right? That's used in process cleaning and processing. And so customers want to see tools that are more efficient, run faster, and they also want to see tools that reduce the cost of consumables as they expand and get these fleets from a few tools to tens and hundreds of tools. And so I think there definitely is an opportunity for the company to invest in development of a faster and more consumable conscious CMP tool. That's our priority, and we've begun kind of the lower cost part of that, which is the architectural designs and the development on some of the changes that would improve consumable usage. Actually doing the full design and building out the first article tools requires capital, and so we're exploring options of how we would do that throughout this year, so that we can get those development projects fully funded and capture kind of the market in 2024 for the next generation of tools. Similarly, on the grind side, the tools perform very well, but as these guys go from 20s or 30 of these tools to maybe 100 or 200 of the tools, they're much more conscious again of the water usage and of the throughput per unit area of space in the factory. And so we've done some conceptual work and some preliminary design work on some architectures that would bring significant improvements to the customers, and we've shared those with our partners and have a lot of excitement. And so, ideally, we'll bring a little bit more capital into the company later this year and kick off those development projects to develop the next generation of tools.
So just touching on that point, is that the typical ramp up you see for your customers in Silicon Carbide? Although it's relatively new in terms of the production sizes for these individual customers, but going from say 10 or a dozen tools to 100 to 200 over the next couple of years.
Yeah. I mean, if you look at the growth rates, predicted by most analysts in the market, and you look at the announcements of factories that the large suppliers have announced, yeah, those are the kind of numbers that it looks like. And so, we obviously plan to participate in that,
Yeah.
and we want to go out there with products that are very well targeted at what the customer's needs are. And so, yeah, we've had a lot of customer interaction over the last 6 months, and really, I think we really have a good idea of what we need to do, and really it's just a matter of now. And the good thing about Revasum, with the 74-year of Strasbourg history behind us, we've done almost everything before. You know what I mean? There's a
Yeah.
huge box of designs, of different tool configurations that have been done over 70 years. So it's not a lot of invention for us. It's really architecture and configuration to get the right set of features into a tool that really meet this market. And I think we did that successfully when the market transitioned from 4-inch to 6-inch silicon carbide, which was about 7 years ago. And so now's the time to do it again in preparation for the transition to 200 millimeter.
Yeah, okay. And it's probably a fair assumption to say that these individual fabs would only try to use one grinder or polisher rather than having products from different suppliers, because that would make their production process probably more expensive and more clunky, I guess.
Yeah, I would hope so. I mean, what we've seen generally is that they will have two suppliers just to keep everyone honest, but the share depends on who performs better, right? And
Right.
these guys are growing so fast and they're so busy. The support that you give them in terms of process and tool reliability and availability and responsiveness to when issues occur can really make a difference. And so, our goal is to get the lion's share. Even if they have two suppliers, they can go 80-20, right? So you want to be in the
Yeah.
80%, not the 20%.
Yeah. So can you talk a little bit about what's been happening in the business, say the last sort of, 4 to 6 months? So coming into 2023, basically.
Yeah, we talked a lot about last year about supply chain issues, and unfortunately, I can't say that it's fully resolved. We were successful. We had one major mechanical component where we qualified two new suppliers. We had really been struggling, and so now we have two suppliers that are supplying that part, and that's what really allowed us to start, opening up the gates and shipping tools again in volume in the fourth quarter and coming into this quarter. We've also been successful in a number of cases for some of these motor drivers and controllers in finding alternative sources that had shorter lead times, which has facilitated us in our overall manufacturing process. The reality, though, is that there are still a few components that are kind of widely used in industrial tooling, particularly like programmable logic controllers and the input and output interfaces that connect those computers to the moving parts of the machine. And those things, they all use semiconductors, and they all use semiconductors primarily made in China. And so
Right.
there still is a shortage of those parts, and the lead times are rather long. And so, one of the things that this improved capital position, balance sheet position allows us to do is those aren't the most important, expensive components of the tool, but you can't ship the tool without it, right? So it gives us a little bit more flexibility to buy ahead on those super long lead time components. So that's something that we're putting in place now, and hopefully it'll improve. I kind of expected that it would, based on kind of the downturn in the general semiconductor market, but we haven't seen it yet. And we've channel checked with our other partners and other people in the industry, and it's pretty widespread. It's not just us. Everybody is having trouble getting these particular
Right.
parts.
That's it's funny in itself, or ironic, because it's not the most complicated product, right? It's pretty standard, I think, these types of modules.
Yeah, the difficult part is that if you change from one supplier to another, it requires a lot of change into the software stack, right? And so it's some of the other parts are easier to change, but these are kind of integral to the function of the tool, and so it's expensive and time consuming to try to design
Yeah.
on somebody else, and that you risk the problem that that guy also may have extended lead times because he's sourcing from the same semiconductor raw
Right.
materials that the other guy is. So we're looking at that, but I think the only solution to that right now is really just to get the orders in place and to support our growth. But like I said, it's not a huge component of the cost of goods sold, and it's kind of a long pole in the tent, so I think it's manageable.
And so if you look at the silicon carbide tool market for this year and next year, what are you seeing? What are your expectations in terms of growth? There's been fab announcements and these fabs need to be filled in the next little while. So in general terms, what are you seeing, and where's most of the growth in, for instance, by region, as an example?
Yeah, I mean, we see growth in the U.S. and in Europe. I think that this year we'll have, if you look at kind of the analyst view of Silicon Carbide, you typically see like a 40% compounding annual growth rate over the next 5 years. I would say that 2023 will probably be a little bit under that, just because there was so much growth in 2022. These guys filled up the space, and then they started building new facilities, right? And those new facilities take a year and a half to come online. So I think we'll have, somewhere south of 40% this year, but probably greater than 40% in 2024. And so we expect to, participate in that growth as one of the leading suppliers in silicon carbide wafering.
Right. And so what are your customers saying in that respect? They're seeing that same sort of ramp up on their end then, I'm assuming.
Yeah, they're super busy. They're all like making as many wafers as they possibly can. They're all kind of, I would say, aggressively growing their manufacturing and trying to get more wafers out of the tools that they have. And so, we've been supportive of customers and trying to, minimize downtime on the tools, make software upgrades that give small improvements to productivity and things like that to help them as they bring on more space, which is really, it's space and power for these guys. They need a lot of energy to form the bools. And so building out that infrastructure does take time. So that's why I think this year may be, on the south side of 40%. I would expect next year to be a little bit higher as these new facilities really begin to come online in earnest.
Right. Okay. Last question, Scott. What is keeping you up at night? What are your biggest sort of bottlenecks in the business and or the hurdles? And it could be several. You talked a little bit about supply chain issues, although that might be might be resolved this year. But anything else where that keeps you up at night?
We're real pleased with the progress we've made over the last 6 months, frankly. So we've made a lot of changes to our manufacturing line. One thing we want to do is we want to get more efficient in how we build tools. Particularly the grinders. The grinders take a lot of precision. I mean, these things that get put together, it's an 8,000-pound piece of equipment, and then there's 300 millimeter platens that end up aligned to less than a micron precision. It's a big, heavy tool and a very, very precise tool. And so,
Right.
We want to get better in terms of our ability to assemble those tools right the first time and meet the tolerance specs and get them out the door. So we put a lot of work in terms of training our employees and changing the way we build the tools to a more sub-assembly focus, where we can build sub-assemblies in advance and then come together at the final stage and do that final setup on the tools. I think the other concern I have is really on these long lead electrical components, programmable logic controllers and I/O slices. We fight that battle every day, just trying to pull in those parts and make the shipments that we need. So we'll continue to keep a strong focus on that.
Thank you very much for your time. And we look forward to seeing the company sort of progressing through this year. It's exciting times to be in this space, right? So we'll keep a close eye on it.